All that being said, let's move on now to Alberto's question. He emailed me a few questions this morning that can all be handled very quickly. Now, Alberto says, I've got about a $30,000 budget, so I can't afford the big names. You might be talking about Tesla. You might be talking about Amazon. I'm in the same boat, essentially. But I still want solid underlying top 1% loss with some room for growth. Now, he says, considering the above and the high volatility in the market, well, there's some fluctuations, but the market isn't really that high volatility right now. But in any case, he's asking about the married put approach. What three variables should I look at to create a successful married put portfolio? Would you recommend to set a married put with a short to midterm time frame, or is it worth looking for longer term investments with this strategy? He says he gets a bit nervous when keeping money tied up. No, we're going to address that first. I do not look for shorter term, and there's no need to be nervous because you have a controlled risk with the married put structure. You know that the worst case scenario you could see is a loss of 5, 6, or 7%. And it's not like a covered call that you sold that's maybe 8 months at a time. You might not do that, but if you sold a covered call that's 6 months at a time, you have to wait an extended period to get time value decay to make sense to buy it back. With the married put, you're in control. You bought the stock and bought the put. You can close it at any time. Because on to say, how do you go about customizing it in the search tool? Can you spare some time explaining the common scenarios we might have to face and how to manage the position? And finally, would you start a trade in December? If yes, what would your cutoff date be, or would you wait till January? All right, so to answer some of these questions here directly, and we'll address them a little bit more. But let's take the last one here, of course. Sorry. The last one, would you start a trade in December? Absolutely. I'd start a trade anytime because it's a controlled risk position. I don't have any fear with the married put structure. Yes, of course, we'll show how to do that, and we'll go use the portfolio to show some common scenarios that are happening. And of course here, what is he talking about with the 1%, and would we ever use a short term? Let's address those right now. Okay, so moving on. Would I ever use shorter term? No, and this is due to one of the 3 core principles of radioactive trading that really applies to any option strategy, not just the married put position. The 3 core principles are proper position sizing. You covered that when you mentioned the 1%, Alberto. The other rule is the at the money bell curve, which you look at any option chain, any expiration. The at the money option always has the highest time value. That's where we want to sell. The in the money and out of the money options have the lowest time value, and that's when we typically want to buy in any structure, not just the married put. But coming down to the time decay curve, radioactive decay curve, is the 3rd principle. And that's what we're going to look at. This is why I would never do a 2-month out or 3-month out put for protection on the position, unless, of course, as part of a different structure, maybe a standard collar or something along those lines. What are we talking about with the time decay curve? Well, now nothing ever stays the same. But assuming the stock price, implied volatility, and other things remain the same over time, if I buy an option that's 150 days out, in the first 30 to 60 days, I see a very slow time decay on the option. It's not quick. It's not rapid. It's very slow and gradual. If I buy a 90-day out, well, I start to see a little gradual, but then I'm almost a third to half of the way down after the first 2 months, and then I lose the remainder of that time value, which is your true risk, which you paid into the married put. That's your time value risk. You lose that at the end, in the last 30 days, really. And if I bought one 2 months out in time, that decay becomes rapid. What does this mean? It means I have less time, obviously, to generate income and less time for the stock to go into my desired direction, and less time to try to fight this time value that I'm losing. That's why we want to be out here. 150 is the minimum that we start. On average, I'm probably 210 days out in time, 240, almost 8 months out in time. So I get a very slow time decay. And then, of course, as I get closer to expiration, that time decay drifts off. But I had all this time in here to do other adjustments, generate income, and I probably closed somewhere in this time frame before I hit the expiration. That's all described in the blueprint for the proper approach to the married put structure. Another reason Why? Is that options are priced in a specific way, meaning that the option that is 6 times the amount out in time, the option that's 6 months out in time, is not 6 times the cost of the near-term option. The option that's a year out in time is not 12 times the cost. You get a lower cost per day buying further out in time, which of course also shows us what? That when I'm selling for covered calls for premium, selling a covered call against this longer-term married put, bull put credit spreads, selling the call in a calendar call or calendar put spread, I want to be selling shorter term, week by week, every 2 weeks, month by month. When I'm buying the long call in a calendar spread, the protective put and the married put, I want to be buying further out in time to put time on my side and to avoid the rapid time decay and have a lower cost per day. Here's a profit and loss chart of one of the married puts that came up on the default search about 25 minutes ago when I started putting the slides together for Alberto. The initial one that came up on the default screen, we'll take a look at in a minute, was buying AbbVie at 107. This might be outside of Alberto's range. We're going to take a look at that with the search, though. And then buying a January 120 put for 23.50. Am I paying 23% of the stock price for this insurance? Essentially, yes. A little bit less than that, 20% or so. But this put is also $13 in the money. So that means only $10.78, the time value, is the true risk. And that's 8.2% for 413 days. 100 shares in one put would be a $1,078 risk for 413 days, or $2.16 per day at risk with the far out option. Or just look at it per contract size, 1078 would be, 2.16 cents per day, 0.0216 cents per day. And that roughly translates to 0.02% per day for the next 413 days. Same strike, the 120 strike for February, 77 days out in time, is only 1523. It's still about 13 points in the money. So the max risk is only $250 for 100 shares. It's a lower cost too, right? I'm only paying 15 instead of 23, so we're paying $800 less. $250 for 77 days is $325 per day. I have a lower cost per day going further out in time because this option, 413 days out, okay, which you can see that there is roughly about 5 times the amount out in time, is not 5 times the cost of the near-term option, is it? It's only $8 more. That's the value of going further out in time. And again, just the contract size 250 is only 0.0325 cents per day, or 0.033 cents per day. And 2% risk over 77 days is 0.026% per day, more than even 0.02% per day. That's the advantage of going further out in time, not just the time value, but getting the lower cost per day. So even with a smaller budget, even with a smaller, a smaller allocation to the structure that we're talking about, I wouldn't change it and go shorter term. That does not put time on your side, and you end up paying a higher cost per day. And if you stayed in this for 413 days out to January 2022, and you bought this in the money put 5 times roughly, in a sense, about 5 times, the risk is higher. 5 times 250 would be higher than just the 1078 risk I can get right now. Okay, so that's why I would never go shorter term. That's why we talk in the blueprint the minimum, and the default search and power options, the minimum 150 days out in time. Now, we're going to have to use power options to discuss some of this, but what did he mean in that first part? He wants to keep the risk to a 1% loss. That's our second layer of protection we discuss in the blueprint, meaning that I want to control my risk, as we saw, to that 5, 6, 7, maybe 8% with that AbbVie January 2022 position. but that monetary risk of $1,000 should only be 1% to 2% of my total portfolio value. So what he's asking is to set up the married put search so he sees positions that just have $300 of total risk or less per trade. Very easy to do. Now let's talk about this. Considering these ideas, what are the 3 key variables that I should look to create a successful married put portfolio? Well, the married put is a bullish strategy. We don't sugarcoat that. I'm looking for stocks that I feel have the potential to grow 3 to 6% in the first 20 to 40 days. And by the way, looking at my analysis over the last 4 years again, adding the analysis for 2020, which I started, I'm right about 68, 69% of the time, meaning 68% of the time, the stocks that I pick for the married put structure do move up 3 to 6%. About 80% of the time they move up. It's just those other percentages don't move up the 3 to 6%. And so I want a performing stock, a stock that I feel has that potential. But again, as we talked before, I'm not afraid if it doesn't because I have the controlled loss in place. In addition to that, the blueprint, of course, teaches 12 different income methods. Some are best used if the stock moves up. Some are used if the stock moves down. You can still lower cost, generate income, profit to the downside with some income methods also. And if the stock's neutral, there's a couple income methods, I think 3 income methods that are best used if the stock's just stagnating over time. Okay, so that's what we look to follow. We keep the risk controlled with the proper setup that we just alluded to a couple of points on. Why am I going far out in time? Why am I going in the money? And that puts me in that proper position and follows the 3 core principles that are discussed in the blueprint. And can you spare some time discussing the scenarios we might have to face on the married put? Yeah, I'm going to show you the positions I'm in right now. As a matter of fact, we're going to look at that after the search tool. But all of that is discussed in the blueprint. When and how to use the income methods. How not to use them. You can use them incorrectly. I'll show you an example of that. The trading goals that we would look for in a married put. And of course, an entire chapter on when to exit the married put in different scenarios as well. And how are we going to customize the PowerOptions search tool to meet these needs? Well, let's take a look. Now, I have to pause the screen very quickly, and we're going to have to navigate over to PowerOptions. Fantastic. Change over here. Perfect. All right. What we're looking at here, of course, is the 14-day free trial to PowerOptions. Those of you who are just getting started, I encourage you to take advantage of the 4 steps here. The free quick start guide. You can go through different tutorials. There's a variety of archive webinars here in the free webinars section on, as I mentioned, strategies, tools, and more. And of course, trial members and subscribers can schedule the free coaching session at any time. When I'm looking for married put positions, the first thing, of course, I'm going to do is clear off my drawings so they're not bothering us. Then I'm going to click on the married put tab, and we'll just go to search. I can navigate with a quick tab as well. Now, these trades listed here, you see Marvel Tech at the top at 43.38. Married put, we buy the May 46, 168 days to expiration, midpoint of about 665. So this gives us a maximum risk. Some of that cost is in the money, and the rest is time value. The time value is 443, so we have an 8.8% at risk. These are based on the default criteria we discussed that are talked about in the blueprint for the best structure, our preferred structure for the married put approach. As you can see, we're forcing the position to be at least 150 days out in time. A risk between 3.5% and 9%. And of course, some other basic criteria as well for both the stock and the option. Now, Alberto wanted to control his risk to only 1% of his $30,000 portfolio. So we have the percentage risk here, but I can also screen by maximum risk. So if I put in less than 300, that means that any position, the system will go across the universe of options to find just the married puts that match all of our criteria. And when I hit submit now, all of the positions that come up will not have a risk. Did I do that wrong? Oh, I'm sorry, max risk less than $3. My apologies. Per contract. I'm very sorry. In any case, let's do that again. There we go. So we've isolated it down to only 2. Okay, Comcast Corp at 249 and Bank of America at 239. Now, these might be good stocks to own. They might be good for a longer term growth, but you might not be expecting a short term growth on these positions. Follow up to Alberto's question was, how can I customize the tools to find these trades? Well, that's how we would do it to limit you to 1%. But we're following the search criteria that we prefer, that works best for us and has since Kurt wrote the blueprint back in the early 2000s, and Ernie and I have been trading it since 2008, 2007 for Ernie, 2008 for me, roughly. So we're looking at a specific type of stock list, but we can open that up. So let's go to lists. We're focusing on this combined list here, but I'm going to take it out. And we're going to screen across the entire universe of optionable stocks just to find the positions that match our criteria. We've got our risk controlled as we wanted to. We've got the time frame we want to follow the 3 core principles. You don't really have to change any of these default criteria in the options unless you want to limit the maximum risk monetary amount that Alberto did. But what are some other things I might look for now that I've taken out the list? Well, what did we want to see? We wanted to see stocks that has shown maybe good growth in earnings. We could look for some cheaper stocks too. Let's open this up down to $5 per share. We're not going to see $200 stocks. The maximum risk is going to filter that out automatically. And, maybe want a reasonable price to earnings ratio, let's say 0 to 70. I want some mid to large cap stocks. I don't want to see any small caps, so let's just put that in as well. And then for the technicals, I want a good average stock volume. I could even increase that. Want stocks in an uptrend, and I could use other technicals. Let's say I only want to see stocks that are at least 2 days above the MACD cross signal. Or you could use Bollinger Bands if you like, RSI, things of that nature. You can all adjust it. What am I doing? You're going to use the same criteria, Alberto, if you're changing it this way, that you would look for to identify a stock that you feel has the potential to move up 3 to 6% in the next 30 to 60 days. Okay, so let's go ahead and submit that. We've got a nice grouping here. General Electric, 100 shares would only be $107 at risk. So you could do 200 shares of this if you wanted to start your portfolio. Pilgrim's Pride at 198. Okay, so we might just do 100. If you did this MBT one, it's only 82 cents, so you might do 3 contracts of that one. 300 shares and 3 contracts. That's the second level that we're talking about. You've got still Bank of America and Comcast are in this group. All right, Comcast is there, Bank of America is there, and you've got a mix of other financials, some bigger companies, food companies, and of course on page 2, HP is in there as well. Cisco also, Western Union. So you've got some tech stocks. You've got some banking stocks. You've got some earlier today, when I was running this search for these ideas, of course, to help Alberto, BP Shell was in here, or BP was in here, and I think another gas company was in this one as well. Iron Mountain's in here also. There was another mining stock I saw earlier today. So that's how easy it is to structure the search. What are the 3 key variables was his direct question. I want the proper structure, the proper risk. You have a specific for the monetary risk to be 1%. There are some 4% risks in here, some 5% we saw, 6%, a good mix of risk. The second variable, of course, you want the proper structure for the put. That's already set for you. You can tweak it slightly. You want to look for stocks that, of course, are in an uptrend, have shown growth and good management. And of course, you're looking for a stock that you feel has the potential to move up 3 to 6% in the next 20 to 40 days, and then more beyond that as well. That's how you'd customize the search tool. You're keeping your risk to 1% of your total portfolio value, or $300 per position. Okay, and in addition to that, we added some couple technicals, but we added some other fundamentals here since we took out the list. We have a nice listing of only 18 positions to go through. And that's how you'd start structuring your portfolio. If you find a position you like, you're going to take a look at the stock chart, company information, news, profile. Okay, I don't think General Electric, this isn't a direct recommendation or suggestion. I don't think General Electric has the strength to move up 3 to 6% in the next 20 to 40 days. So then I'll just skip it and I'll start researching Pilgrim's Pride. I'll take a look at the stock chart, company information, and so forth. And again, I want to open this one, knowing that I keep my risk to $300. I'd buy 100 shares and 1 put. and my total net debit would be about $2,400. Okay, so we still have about 37,600 to keep trading, so we'll look for a new trade. Now, as a general rule on that note, what Ernie and I always suggest is if you're starting new, opening a Mary put portfolio, following the rules in the blueprint, don't go in and open 6 or 7 positions today. Open 1 or 2. Wait 7 to 10 days. Open 1 or 2 next week. Might be subtly different market conditions. You might see different trades. And then open another 2 or 3 the following week. Okay, so don't lump them all in at once, Alberto. Usually we approach is take 1 or 2 at a time, wait 7 to 10 days, maybe even 20 days, and then open 1 or 2 more. You might see something different in the market conditions and some other positions coming up in the search results as well. Okay. Okay. This is touched. Magesh just asked a question. Magesh we're going to get back to Alberto in a second here for that, what he talked about with the trades. But Magesh asked, based on the blueprint, which Magesh has purchased and is going through right now, he said, is there any concern about the implied volatility or the range of implied volatility that we should be looking for? I'm going to keep on this search for now, but Magesh, as you can see, and we do this a lot, I'm not filtering by delta or implied volatility. Everything in options trading works hand in hand. So the structure I'm looking for to keep the risk to single-digit ranges, to not go more than 20% in the money, which lowers my expectancy of profit too low. That's another restriction talked about in the blueprint and is here in the search. Look at my implied volatilities here. We're between 0.25 to I think 0.522 is the highest. Maybe there's a point. Okay, there it is. It's right there. That's the lowest and highest on this first page. 0.2089 to 0.5527. That's a pretty restrictive implied volatility, and I'm not even filtering by implied volatility. Same is true if you have a question of delta. Well, what delta to use? I don't. I use the criteria because you don't need to use delta. You're actually already filtering by delta to get the proper structure. What is our range here? It looks like 0.52 is the lowest and 0.86 is the highest, and that's an aberration. Usually it's no higher than 0.7, 0.74. So this one is pretty high on AB, 3341 with a July 40 put. Yeah, that risk is so low, 4.8%. If there's a 37.5 put on this stock, it'd probably be only a 6.5, and that would be a better target for me. Okay, but that might be too high. That's an aberration. But in general, 0.52 to 0.74, pretty restricted delta. And as I mentioned, there is no filters for implied volatility, high or low. There is no filter for delta. We're already filtering by it with the other criteria. All that being said, Nagesh, one thing that we do suggest is that the implied volatility range, where is the put options implied volatility now compared to where it has been over the life of the option? You don't want to pay into too high of implied volatility range, so you might want to restrict this to be below 70, be below 80, so you're not at the height of the total range. You have to take that with a little bit of a grain of salt as well. And so that narrowed it down just by 4 or 5 results. We still have 14 good positions in here that are in their lower implied volatility range, 40, 30, 57, highest I saw was 68, I believe. So those, and here's some low ones at 29 and so forth. So the percent implied volatility range is more important because you're already actually filtering by the percent, by implied volatility, excuse me, Nagesh, without screening by implied volatility.